Hi, I'm Assistant Professor Aditi Mathur, International Schools of Business Management, Suresh Gyanvya University, Jaipur. And today we'll be understanding the approaches to determine appropriate capital structure with the help of EBIT EPS approach. Right? So in our previous videos, we have understood what is capital structure, what are the needs to have a very sound capital structures, right? What are the benefits associated with having a very good, well-designed capital structure, right? And we even looked on the four important theories which are related to the capital structure. So in today's video, we will be understanding how to determine the appropriate capital structure. So basically, there are three approaches. The first is EBIT EPS approach, which we'll be covering in this video lecture. We also have valuation approach and cash flow approach. But this video lecture will focus on EBIT EPS analysis. So first of all, before I begin, what is EBIT EPS analysis or the approach? Let's just discuss what is the full form of EBIT and EPS. So EBIT's full form is earning before interest and taxes, and EPS, as you know, stands for earning per share. So the EPS EBIT approach or EBIT EPS approach to the capital structure involves selecting the capital structure that have maximum EPS over the expended range of EBITs. So we have discussed why do we need to have a good capital structure is one of the reasons that we should have a capital structure which increases your EPS, right, at the lowest KO, that is cost of capital, the overall cost. So this approach help you out to accomplish one of the very important aspects of an organization, that is to maximize its EPS. Using this approach, right, we emphasizes on maximizing the owner's return, right? So EPS is actually what? EPS is actually the return which owners earn, because the formula is what? Is earnings available to the equity shareholders. So equity shareholders are the owners of the company. So to calculate EPS, we divide the earnings which are there for the equity shareholders or which are earned by the equity shareholders divided by the total number of outstanding equity shares. So when we divide it, we get the earning per share which is there or which is earned by the equity holders, right? And the EBIT EPS approach can help balance a company's debt with its equity. And it helps you out to do that, because of which it is considered as one of the very good approaches to have or to identify the optimum capital structure. Effective business management requires careful planning and decision making about the balance of debt and equity used in the financing of the business. Why? Because both these sources, that is your debt and equity, have good quantity of cost associated with them. And definitely we want that ratio which gives you the maximum return in comparison, and you will like to incur less of cost to incur that maximum return. And that is what this EBIT EPS analysis or approach helps you out to determine. The EBIT EPS approach is one of the methods available to the managers to guide them into making the decisions about the capital structure, right? And this approach is one of the very good tools which managers use to decide on the right mix of debt and equity to finance its business and to arrange the capital structure. So we have understood that why we need a good sound ratio of debt is to equity. So but how to approach it, how to achieve it, this is one of a very commonly used and the easy method. The benefits from this method helps to understand the basics of how it works as well as the advantages and drawback. right? So the EBIT EPS approach, the business plots in this approach, so in this approach, EBIT EPS analysis, the businesses plots graph or its all the performances at the different possible debt is to equity ratio, such as 40 to 40 is debt and 60 is equity, or the vice versa, that is 60 is debt and 40 is your equity, or 50-50, or 10-90, 90-10. There are n numbers of mixes. So what they do, they plan out all them in a graph, and then later on they analyze the replications of having each of the mix. So we will understand it how we do it when we come to the numerical part. In the basic graph, the EPS of such data is pointed at each level of earning before interest and taxes at different EBIT ratios. Right? So the first is to identify the different ratios. The second is to write the EPS associated with those ratios. This graph or this tabular representation then helps you to determine the ideal level of debt is to equity for a business at which you have the maximum EPS. Right? So the step one is to identify the ratios, the different ratios of debt is to equity. Step two is to calculate the EPS corresponding to each of the ratio mixes. And then the third is to identify the ideal level or the optimum mix or the optimum ratio of debt is to equity at which you are gaining maximum EPS. So EBIT EPS analysis is actually designed, it designed various alternatives of debt and equity and preference shares in order to what? In order to maximize the EPS at a given level of EBT. So we have discussed the process. So this is one of the ways to explain that step-by-step process. The first one, to identify the different ratios between the different sources of your capital, and then later on examine how different capital structure affects the earning available to the equity shares, that is the EPS. So then you draft and calculate the EPS at each level. It is analyzed, It is the analysis of the effect of financing alternatives on earning per share. EPS and EBIT analysis helps you out to design the capital structure of the firm in such a way so that to minimize the cost of capital. You consider all the costs associated before you come up to the conclusion, right? So this is one of a very good and one of the very commonly used approach to determine how to have or how to identify the ideal capital structure. So let us just first understand how we come up to the EBIT, that is earning before interest and tax. So what we do is that first we write down our sales figure, then we subtract our variable cost, and after subtracting the variable cost from the our sales value, the amount which you get is known as your contribution. Then from contribution, you subtract your fixed costs, and then the earnings available after deducting your fixed costs from the contribution is stated as your EBIT, that is earning before interest and taxes. So till this step, you have not paid the interest and you have not given the taxes, right? So what you do, you first take the sales figure, then subtract the variable cost, then you come up to the contribution. Then from contribution, you deduct your fixed cost and you say that you have reached to your EBIT. Now, how to calculate your EPS? So from this EBIT which you have received, that is sales minus variable cost, you get contribution. Then you deduct your fixed cost and you get your EBIT. From this EBIT, first you pay your interest, right? After paying your interest, you get EBT, which is earning before tax. That means you have paid the interest component. Then on this EBT, you deduct the tax amount and you get earnings for equity shareholder. And this is when you have no preference share, right? So this is earnings for equity shareholder. So let us just assume that you have preference share. Then your table will be EBIT minus interest, which will give you EBT. Then you deduct your tax, you come up to EAT, then you give preference dividend, and then you say you have arrived to earnings available to equity shareholders, right? And when you reach up to this point, that is earning available to equity shareholder, you use this amount and you divide it with the number of outstanding shares, equity shares, and you say you have come up to your EPS, right? So the formula for the EPS is earnings available for equity shareholders. That means till this point you have paid all the interest amount, you have satisfied the government by giving the tax, you have given the amount to the preference shares holder, whatever the dividend they were committed, and now the entire amount is for the equity people. That means the real owner of the company. And then when you divide that amount with the number of outstanding equity share, you come up to your EPS, that is earning available, that is to you come up to. So you come up to your EPS, that is earning per share. So this EBIT EPS analysis is done with the help of a break-even analysis, right? So the EBIT EPS break-even analysis is what? That the level of EBIT at which your EPS is same for two alternative financial plans, right? So at this point, you say that you have reached to the indifferent point or the level. So now what happens is that in our EBIT EPS analysis, in our step number 1 was to identify the different ratios or the components of the different mixes of debt is to equity. So now what happens is actually the management, they draft their different plans. That means they have different options of debt is to equity in front of them, right? So it can be 10 is to 90, 90 is to 10, 60, 40, 40, 60, right? 50, 50, right? So now what happens is we try to come up to a break even. So one of the ways to identify your capital structure is to compare the two plans. And when you compare the two plans and you find out that the EPS at this two level are same, right? So if you were earning EPS of let's say 10, so over here it is also 10. So these two plans are what? These two plans are your so these two plans are your actually the indifferent level, or they both are at indifferent point. It doesn't matter to you whether you go for 10 is to 90 or 90 is to 10, because down the line from both the options you are going to earn the same EPS, right? So your EBIT EPS analysis is a scientific base for comparison amongst various financial plans and show ways to maximize your EPS. It is a tool of financial planning that evaluates various alternatives of financing a project under various levels of EBIT. And this analysis also suggests the best alternative having the highest EPS and determines the most profitable level of EBIT. Right? So these are the few of the very important points which we should know when we study our EBIT EPS analysis. So the firm may have various combo or the various ratios between the different sources of finance. So what are these? It might be all equity based firm. That means that there is no borrowed funds. That means there is no borrowed funds associated with that company. That company is solely functioning and working on the equity amount. Then the another types of the category of the firm you can see is that the equity is to preference. That means again there is no enrollment of the debt part, but you have preference shareholders with you, right? And the third variable is that there are various combinations in front of you. That means you have few amount of money from equity, from the preference share, few you have borrowed the fund. So these three types of the levels of EBIT are drafted, or the capital structures are noted down, and then related to that the EPS of each option or each combination is calculated, and the one with the maximum EPS, that plan is picked up, and we say this is the ideal ratio or the ideal capital structure for my organization, right? So now let us just understand by solving a very small question. So we have a Limited, which have a EBIT, that is earning before interest and tax, of amount 3,20,000, right? And the capital structure of this A Limited is that they have equity share of 4 lakh rupees, 10 each. That means they have 40,000 equity shares. Then they have 13% preference share capital of 1 lakh rupees, and they have 9% debentures of 2 lakh rupees, right? So this is a company which have the three sources from which they have they have established their capital structure. They fall under the category of 50% tax, and we have to calculate our EPS. So we know that we have EBIT of 3,20,000 rupees. So from this EBIT, we will first deduct what? We will deduct our interest. So interest is calculated on debentures. So let us just see. We have 9% debentures of 2 lakh rupees. So the interest which will be paying to the debenture holders will be 18,000. So the amount remaining with us after paying the interest to the debenture holders, that is your earning before tax, is 3,02,000 rupees. From this EBT, you'll be deducting the tax, which is 50%. So from this 3,02,000, you deduct 50%, which is 1,51,000, and the remaining amount is your earning after tax, which is 1,51,000. And from this EAT, you deduct your preference dividend. So the preference dividend is 13%, and you have 1 lakh rupees amount. So the 13% of 1 lakh is 13,000. So now the earnings available for the equity shareholders is 1,38,000. Don't forget, we have to calculate the EPS. So what is the formula of EPS? The formula of the EPS is earnings available for the equity shareholders divided by the number of equity share. So we have calculated the number of equity shareholder at the very beginning. That was 4 lakh divided by 10. We got 40,000. So your EPS is 1,38,000 divided by 40,000. You get 3.45 rupees, right? So at this capital structure level, company A is earning EPS of 3.45 rupees. Isn't that easy? So the only thing, students, which you should remember is that the flow of calculation. So I recommend you all to please learn that flow step by step. It should be on your tips. That sales minus your variable, it gives you contribution, minus your fixed cost, it gives you EBIT. Then after EBIT, you deduct your interest to get the EBT. Then you pay your tax. Then you get AAT. Then you give your amount to the preference dividend. Then you get the earnings available for the equity shareholders. And the EPS formula is earning available for the equity shareholders divided by number of shares. Then you get your EPS. Right? So it should be on your tips, because the question will be very simple. Everything will be given to you in the question itself. It is just to draft this schedule, come up with the answer, and then use the formula and calculate your EPS. Right? So now let us just understand another situation. So what we have studied right now is to how to calculate EPS, right? So there are constant EBIT and changes in financial patterns. So now let's solve another very important questions. This is the different type of a question which generally comes in your EBIT EPS pattern. EBIT EPS. This is the another type of question which comes in your EBIT EPS calculations. So let us just assume that there is a ABC Private Limited, which is expecting the EBIT of your 1,50,000 per annum, right? And 5 lakh rupees is your total capital, which is invested in the organization to earn 1,50,000. And they have given you the different sources from which they have come up to this 5 lakh. The company has access to raise the funds of varying amount by issuing the equity share capital, 20% preference share, and 10% debentures, and the combinations of equity is to debt is to preference. Suppose it is analyzed that the following 4 options to raise the required fund of 5 lakh. So now what they are giving? They are giving you the 4 options. Remember, in the very beginning of this video lecture, I have told you the management sit and draft different ratios or the different plans in which they can come up to their capital structure. So they have given you 4 options through which they can, come up to this 5 lakh rupees investment of the total capital. And they have also given you that this company fall under the category of 50% tax bracket. And they have asked you out to calculate the EPS. Right? So let us just first understand the capital structure. This part of this table shows you the capital structure of these 4 options which the management have. Right? So in option number 1, the company is raising entire 5 lakh rupees. Sorry, this is a misprint. It is 5 lakh. So entire 5 lakh rupees from the equity share. In option number 2, the company is raising 50% from the equity shareholders and 50% from the preference shareholders. In option number 3, company is issuing 50% from the equity, 25% from the preference, and 25% from their debentures. And in the 4th option, they are having a ratio of 25:25:50. That is, these are the 4 options available to them through which they can come up to the total funds or the total capital of 5 lakh rupees. Right? So now let us just calculate the EPS at each level. The first point, that EBIT for each level is 1,50,000. So we have written it 1,50,000. Students, please always solve the questions in this table format only. Draw your rows and then neatly calculate it so that it is easy for you to even do the comparison. So the first step is to write down the EPS. So we have written the EPS of all the 4 plans, which is same, that is 1,50,000 rupees. From the EPS, we deduct interest to come to your EBIT. that is earning before tax, which is also known as profit before tax. So don't get confused with the term earning and profit. It is same, no issues with that. So in the first option, you don't pay any interest. In the second option also, you don't pay any interest. But in the third option, you have 10% debentures, right? So 1,25,000's 10% is 12,500, which you will be deducting because it is your interest amount. In the option number 2, your interest is 25,000 because you have issued your 2,50,000 from the 10% debt, right? So after deducting the interest, you come to your earning before tax, and it is 1,50,000, 1,50,000, 137,500, and 125,000. After your EBIT, you deduct the tax, which is 50%, 75,000, 75,000, 68,750, and 62,500. After deducting it, you get your EAT, that is earning after tax. That means till this point you have paid the interest, you have satisfied the government by paying the tax. So now this amount is of the company, which is earning after tax. And from this, the preference shareholders will get the preference when they get the dividend distribution. So in the first option, there is no preference share capital. In the second, third, and fourth, we have the preference share capitals. So you pay the amount to the preference shareholders. So after paying the amount to the preference shareholders, you get the earning available for equity shareholders, right? And in option number one, you are having 75,000. In option 2, you have 45,000. In option 3, you have 53,750. In option 4, you have 47,500. Students, just look to this part, right, and decide which option you will select when you have these following earning available for equity shareholders. Definitely, I know your answer will be option number 1 because it is 75,000 rupees. But no, this is the wrong method to select any plan, because the plans are selected on the basis of your EPS, right? Your denominators should be same, right? Your basis should be same. So with the help of the EPS, that is earning per share, you come up with the accurate answer, and then only you can, compare all the options and select the best one. So over here, when you divide it with the number of equity shareholders, your EPS is 15, 18, 21.5, and 38, right? So thing to be taken into the consideration is that it is not the only EBIT which decide that which option is to be taken. It is not the earning available for the equity shareholders which decide that which option is to be taken into the consideration, but it is the EPS which helps you out to determine the best capital structure. Because down the line, what is your main objective? Your main objective is to maximize your wealth, and EPS is one of the ways through which you can maximize the wealth. So to have the maximum EPS is the downline, the main motto of the organization. And in option number 4, you have your 38 rupees EPS. So that means that option number 4 is ideal ratio or ideal capital structure which a company should have so that it can have the maximum EPS, right? And if you see this option, there is a good quantity of debt, there is a good mix of debt, equity, and preference, right? And if you remember the capital structure theory also, in which I have told you that the companies which have the value of debt enrolled in them, right? Their value is always more in comparison to the company which have the no debt component, right? So this is, you can see that if you don't have any debt, you just have EPS of 15 rupees. But if you have a good amount of debt under your capacity, right, then you have a maximum EPS, that is your 38 rupees. So what we have done, we have first choked down all the options available, and then slowly, one by one, we have solved the EPS and we have selected the best option, which is option number 4 for your ABC Limited. So now let's just discuss few of the advantages and limitations associated with your EBIT and EPS analysis. Let's first discuss the advantages. The first advantage is your financial planning. So with the help of these two examples, you have understood that when I'm drafting my capital structure with this EBIT, EPS, pre-hand I am calculating the amount of interest which I have to pay, the amount of preference debt which I have to pay, the tax element. So I am planning financially that amounts which will be there in front of me after a few months to be paid off. Right? So I am doing my financial planning with the help of EBIT, EPS. So it helps you to draft your financial plans. The second advantage is your comparative analysis. This analysis, your EBIT, EPS approach, gives you a very beautiful way to compare the different opportunities you have to raise the capital and select the best one, the best suitable one for your organization. So in this previous example, which we have seen, you had 4 options and you selected the best one because the EPS at that combo of the debt is to equity was the maximum. Right? So this gives you a comparative analysis. The third important advantage which this approach gives you out is the performance evaluation. You can evaluate the performance of your organization at the different combinations of the capital, which we have done in this previous example. See, you were able to analyze that how much I was earning actually after paying the taxes, right? And then how much my company was having with them after paying the preference shares, right? So you get an actual analysis of the organization at different combinations of debt is to equity. And the fourth last advantage which you get is determining the optimum mix, because of which we were doing this entire calculation. Now let's just discuss the limitations associated with this analysis. The first limitation is that there is no consideration of risk element in this entire process of calculating the EPS. We have eliminated the concept of risk in this approach, right? We have not talked about the business risk. We have not talked about the business risk. We have not considered the market risk, the industry risk, right? And the different types of the risk. So this is one of the limitations, that we ignore the risk component, which is practically not possible. Then in second limitation, we actually contradict our results as well. Many a times there are the situation when you have the 2 plans with the same EPS, right? And then it comes to a situation which is your indifferent level, right? And then this is the point at which the management has to take a very bold step, because in both the plans, the EPS will be same. The third limitation is your overcapitalization. With this approach of EBIT, EPS analysis, you generally overcapitalize your book. So let us just have a quick recap of what we have studied today. In today's video lecture, we discussed one of the approaches to calculate the capital structure, that is EBIT EPS analysis, or the approach in which we calculate the EPS and we select that plan which have the maximum EPS, right? So there are basically three steps. So let us just discuss and we will have a quick recap. The first is to note down all the different possible options of debt is to equity for your organization. The second is to calculate EPS of each plan, right? So this is plan A, plan B, plan C, plan D. These are the different mixes of debt is to equity. You calculate the EPS of each plan, and in third stage, you select the best one with the help of identifying that mix which gives you maximum EPS, right? So now let us just see the calculation of EBIT. For EBIT, you deduct the variable cost from the sales, you get contribution, then you deduct your fixed cost, you come up to your EBIT. For the calculation of EPS, from this EBIT, you deduct interest, tax, and then the amount of preference dividend if there, and then you get the earnings available for equity shareholders, and from that you divide with the from that you derive your EPS by dividing it with the number of equity shares. Right, we solved two of the question. The one was to learn how to calculate the EPS, and second one was to select the best option. Students, I will suggest you all to solve as many as questions you can, right? The more number of questions you will solve, the better clarity in the concept, and you will get a good speed to solve it at the end of for the examination, right? So please solve good amount of questions, practice more, practice with the help of your friends, so you all can decide that which questions you have to do together, so that you can have a motivation and a bit of a healthy competition to solve that who solves first. So it will give you that practice of doing the questions at the minimum time, which is very much required for preparing for the end semester examinations, right? So that was all which we have covered in our today's video lecture. We winded up with the understanding of few of the advantages and limitations associated with the EBIT EPS analysis. So now let us just have a quick recap of what we did in this video lecture with the help of the MCQs. So I have 10 questions and we will be solving it right now. So please be ready with your paper and pen, and let's solve these questions to have a good confidence amongst ourselves that yes, we know this concept and we can solve all the questions which will come related to this concept. So the question number 1 and question number 2 is this. Select the best answer which you feel, right? So please select the best option. The third and fourth MCQ. The fifth and sixth MCQ. The seventh and eighth. And the last two MCQ questions. That is question number 9 and question number 10. So now let's just check and evaluate ourselves. These are the correct answers. So the correct option for question number 1 and 2 is option B. For question number 3, it's option A. For question number 4, it's option D. For question number 5, 6, 7, and 8, the correct answer was option B. For question number 9, it was option D. And for question number 10 also, the correct option was option B. I do hope you have scored a good marks in this MCQ quick test, and please solve lots and lots of questions on internet. Also, you have the e-materials available, so you can just go to those questions, solve it by yourself. Until and unless you will solve the question by yourself, you will not get the clarity of the concept. So please solve more and more questions and just have a recap on all the MCQs and the theory part from this video lecture. And I do hope that you have understood the concept of EBIT EPS analysis and how to select the best optimum capital structure from this analysis. So thank you everyone for watching this video lecture. Thank you and happy learning.